Welcome to Dukascopy TV with me, Alex Isat. Joining me today from fingraphs is Jean-Francois Owczarczak. Welcome.
Hi, Alex.
So there's a lot of PMI data out this week and waiting for Draghi to talk about the ECB a little bit more later on. But before that, the big news was the Swiss referendum and the gold initiative. Can you explain what's happening there, and is gold on a downturn?
Okay, well, the gold referendum was putting a bit was giving a bit of support to gold prices over the last few weeks. It never really did create strong momentum. And if you could see here, we're on an investor's view for gold. We have a weekly chart, a daily chart, and an hourly chart. And these three-dimensional charts are meant to give an at-a-glance view of how the trends interplay. So if you look at the long term, it's a bear, the medium term, it's a bear, and the short term hourly chart is in a bear, which basically sums up to a potential continuous downtrend when you have all three bears. Now, what I wanted to show you is that we basically moved up over the last few weeks and hit against the 1200 here, which was a strong resistance. And this resistance, incidentally, was exactly where we found support back at the beginning of October. So it was a strong point, and basically the market rejected it. And the gold referendum just came as a confirmation, or the gold referendum not being accepted just came as a confirmation. Now, we're still negative over the long term. We still think there's some potential. We're into the initial area of our target, the upper end, but we could actually make it below 1,000 if with the lower end of our target. So if we take a middle view, we have targets over the next few quarters around 1050. So that's a bit more downside, more than 10%. On the daily, we're getting extended, but over the next month or so, we could still make it down to close to 1100. So it's still negative down. And on the hourly, we resumed the downtrend following the referendum. And at the moment, we still have targets which could lead us lower. Now, we see in a bounce today, we've had a small exaggeration here. At the moment, we wouldn't be too concerned about the bounce because we still have that 1200 mark, and that's really what we're watching to as a warning signal that gold may be reversing. As long as we stay below it, we'll trust the daily and the weekly.
So moving away from commodities, tell us a bit about the US and the trading Treasury Bonds that are going on. I mean, are we choosing that investment? Is it a risk?
Well, I mean, Treasury bonds were quite interesting because here we have a 30-year, 30-year Treasury bond futures, and as you see, last year it corrected down quite significantly. There was a lot of talk about the anticipation of the tapering, and basically, it seems like some in the market didn't really buy the story. And so people have been investing in long-term bonds quite regularly all through the year, and it has reinitiated its uptrend. It still has a bit of potential to the upside, and at the moment you do see a bit of risk, but we're still moving up at the moment. Now, if we look at the daily, it was quite interesting about a month ago when we had this peak into mid-October. A lot of market analysts had seen a climax top here, which could maybe turn into a reversal. Well, we've seen a nice consolidation, and we're moving back up again quite aggressively. So we could also make it up to 148, 149 as a maximum target here, which pretty much corresponds to the 150 we had on the weekly. So we're still in an uptrend here and still moving higher. And interestingly enough, we could see the hourly, and it basically built a very high base here and just started moving out again. So at least some people are not concerned of holding long-term bonds here and are not concerned about inflation. There's also a funds of flow effect, as many people are moving into the dollar, and that's the most liquid way to do it today. But in terms of anticipating too much growth, well, that would be a mitigant because people already take the risk, are ready to take the risk to be on the very long-term end of the yield curve.
So if people are a bit concerned about the dollar, what's happening with the dollar-euro at the moment then? So
euro-dollar, well, euro-dollar has been moving lower, and it has done all through the year. If you see here on our investors view, you look at our weekly charts, we were in a consolidation up since 2012, which basically founded its end early this year. We've been moving lower quite aggressively. Our targets show more potential down below 120 over the next few quarters and possibly down to 111. So that's quite an aggressive projection. On the daily, we are now quite overextended. We've seen a large part of the move. We could see some our two envelopes touching each other, which is a point of market stress, market exaggeration. Our risk index is in the oversold zone, so it is getting to a point where at some point it's going to see a correction up. Now it's just a matter of anticipating when it's going to happen, and at the moment our impulsive 2 targets still show us a bit of more potential over the next few months, down below 122 and possibly down below 119. So at the moment we would not be buyers of the euro yet, even for a correction up, because the long term is down anyways. Now, if we look at the hourly chart has seen a bit of exaggeration last week and a bounce, and our trend indicator is back in a bear at the moment and showing possible targets between 124.11 to 123. It's still in a downtrend, so also here we don't have any indication yet that we're seeing something significant materializing.
There's not much leeway there.
No, well, there's not much to go here, but you have to see the support you have here from the daily, which is still down, and the weekly, which is also down. So if you have your long-term and your medium-term trend heading down, your probabilities is that as long as your hourly stays bearish, you have the better probability to still be in a downtrend.
And finally, should we just have a glance at the equity market?
Sure. And we'll look at the S&P futures here. Now, it's been quite hard to time tops and bottoms here on the equity markets over the last few years. We've been possibly very bullish until this summer. We did see the break here on the daily. Did expect it to go a bit further, but the rebound was quite significant. Now, since the rebound, we see that our two envelopes are touching each other again, which is a sense of market stress and of exaggeration. We've reached our targets, and we can see our oscillator making it back into the overbought zone. And what is interesting is that this top is probably lower, or is lower than the one we did back this summer, which does give a sense of weakness of the oscillator. So without being too aggressive, we would say that it's probably a good time to take intermediate profit. We could see a bit of consolidation here over the next few weeks. Now, remember, this is the end of the week. It's going to, at the end of the year, it's going to be quite sustained. So we'd also not be too aggressive in calling a reversal here. But we could also confirm that with the hourly, which is very, very overextended. The oscillator in the risk index has been in the overbought for quite some time. That said, our weekly is still good, and so following an intermediate correction, we still be in an uptrend over the next few quarters.
Great. Well, thank you for coming in today.
Thank you for having me.
Well, that's all we have time for today, but make sure you check back in next week for the next weekly update. Goodbye.